All right. Welcome everybody to Midas Investing Live. Been a little while. I know last time I streamed, I said I was going to be trying to do it every 2 weeks, and pretty sure it's been more than a month at this point, 5 weeks or something like that. But hey, things don't always go exactly as planned. I was busy finishing up. I know I was talking last time I streamed about business trips that I was going on, training for my new career in commercial banking. Had one more trip to do in the interim, finished that up, which went well. But that wasn't really the thing that was kind of keeping me from streaming, because that was only one more week. And my plan was originally to stream when I got back from that trip. But then I also kind of got caught up in other little projects related to what we do here. And whenever I kind of get deep in like a project or revamping of some spreadsheet uh, template or product or something that I do around here, I always kind of want to get it to like some sort of state of completion before I share it with anybody. So that kind of just made me put things off for another week or two. And then I also had some busy stuff going on. But either way, the point is I have a lot of stuff that's actually sort of done and ready to show people. So that's kind of why we're streaming here today. First off, take a look at the portfolio. Not too much has changed since the last time we talked in terms of like the actual positions. In fact, I don't really think anything has changed. I've grabbed a couple more shares here or there of some of the major companies. I remember if I bought a little bit more FG since the last time we talked. Maybe I bought it a little bit before the last time we talked. I can't remember, but maybe some FG went in there. Maybe some InMode went in there. Maybe some Hydric and Struggles went in there at some point. Maybe some Mastercraft. So those are things I've uh, perhaps bought in the last month or month and a half, depending on, I can't remember exactly what I had bought last time we talked or not, but stuff I've bought recently. But for the most part, positions haven't changed too much. You might notice I do have a really large cash position at the current time frame. If you recall, I do tend to hold a relatively large index position, but my index position is not a long-term position. I do actually hold a signal-based momentum strategy for it. So when certain signals go certain ways, I tend to sidestep out of the market with that index position. So currently, that's what's going on here, and why I have what is it, 36% of my portfolio in cash currently. It's not because of any particular reason other than I just don't think that the market is a great spot to be in for the current time frame. But that could change literally in a day or two, and that could be back into an index position. In general, I try to hold about 5% of cash as like an actual discretionary hold. But yeah, beyond that, I think last time we talked, I also had some issues with my spreadsheet in terms of the calculation of returns. I remember I was like showing the main page over here at one point. Somebody had commented on the total return being massively down, and that was because there was like an issue with the spreadsheet. So I did fix that in the time frame since the last time we talked. Total returns in time weighted returns for the portfolio is up 64%, which is 8.3% annualized over 4.4 years of deposit weighted time. So that's what the portfolio is really at, which is unsatisfactory in terms of compared to the S&P 500, but is what it is. I think we've only been getting better and better over time. In fact, I hope to show you guys some of the stuff I've been working on in the last few weeks here today that would show you why I have at least pretty high confidence that a lot of the stuff we're doing is going to eventually pay significant dividends in terms of returns in the future. So we've been learning. We've been learning. That's basically the whole approach to that. So let's see, where do we want to start off exactly? I know last time we talked, I spent a lot of time talking about my um management compensation tracking tool that I put together here, which is Find Dandy. But that was really kind of the first piece of things that I had initially wanted to show you guys when we had talked last. And other things I want to talk about was this other spreadsheet I've been working on, which has a lot of things going on in it. There's like many different tabs down here that already have a bunch of different things going on. But basically, it's just kind of a spreadsheet where a lot of my research, so to speak, into terms of like a lot of the different things I've been doing over the last several months, really, has all kind of been compiled into this one space. So I've been kind of researching different industries and themes related to that, which is kind of what this initial page right here is, which we'll talk to. I've also been researching certain brand names and like a lot of opinions surrounding brand names. I've compiled lots of lists online of different opinions about brand names and kind of compiled a rating system into that to try to come together a bunch of different lists, expert-driven lists, consumer-driven lists, as well as employee-driven lists in terms of the best companies in the U.S. or globally, which a lot of them have very obvious names in it. But there's some interesting ones that just kind of pop up in there that you wouldn't necessarily expect to have. It's something I kind of want to start looking through from time to time to see if these companies match up with certain other things that are worth looking at, like having a good theme to it. Maybe look for value within there. Basically, I'm trying to think about different ways to research quality, and looking at different brand names and how it's assessed according to various different ways online. Like I said, employee-driven surveys, consumer-driven measures, as well as expert-driven measures. That's just one thing for like brand name stuff. But then management was another thing that I was doing a lot of research on, like how to research the quality of management. And that insider compensation tracking tool was really just kind of like the first piece of that. That was like one easy to assess thing is compensation. But trying to assess like the actual quality of the management themselves, not so easily done. But I did find lots of lists online of high quality management, and so I did kind of the same process with that, and just kind of like compiled a bunch of other people's assessments, these lists, and then tried to put them together into something. So what I've got here going on is actually like the list is already sorted in different ways. Let me try to unsort it. Really, it's a pretty long list, but I haven't like sorted through all of it. But a list of high quality managers, CEOs mostly, but there's some chairmen in here and a few other non-CEO executives as well. For the most part, it's CEOs. A lot of them foreign companies that I've never even heard of before. A lot of them very, very famous CEOs that everybody's heard of. But kind of piling through a list of that. Some of them have already left their positions as well, so that's one thing you have to keep in mind here. But basically, I'm just trying to compile different lists of quality companies, whether it's through brand name or through moats that they have, or through high quality managers, people that just kind of to pay attention to. And this is all outside of valuation. So that's like one thing that's kind of been a cornerstone of a lot of the research I've done over the last several months, is that I'm trying to do a lot of quality based research that's outside of the financials and outside of the valuation, and really just trying to think about like what is the quality of the brand or the company itself or the moat or the management, before even thinking about the value of the company. So like try to decipher what are the assets and the companies or the capital allocators that I want to own or I want to be in business with, before thinking about the value at all, so that instead we can determine what the value is independent of determining what the quality is. Only divergence is, why do you think there is a relationship between executives and price action? Um, what do you mean by a relationship between executives and price action? I'm not entirely sure what you mean by that. Um, because I'm not sure that I would say that there is necessarily a relationship between that. I guess I'm asking, why are you making this list? Well, because I think it's a good place to potentially look for high quality assets to own. That was kind of like where I was going with it. It's like I'm just trying to determine what are what is good companies based off their brand name, what is good companies based off their management teams, and then also not only just the current companies that the management might be at, but also to be able to pay attention to where these executives might go in the future as well. It's trying to identify high quality assets. That's what I'm trying to do right now. It doesn't necessarily have anything to do with their price action. I mean, I imagine that there would be a strong relationship between the price action of them, because like for example, as I was saying with the management team and the brand list, like there is a lot of obvious names on here, people who are very famous for being high quality executives. For example, like Satya Nadella of Microsoft is an obvious one that's right here near the top of the list. Mark Benioff, Jensen Wang, very very famous, obvious great CEOs, and obviously those stocks have had really really great price momentum over the last several years. And that's because everybody knows that they're a good CEO. So there is like an obvious relationship there. The point is really to try to identify, CEOs that maybe less people don't pay as much attention to, so maybe you identify stocks that are under the radar but have high qualityness to them. The same thing in terms of the brand name too. It's like, there's certain brand names that it's like, oh yeah, of course everybody knows it's a good brand name, like Coca-Cola, or PepsiCo, for example, are obvious ones that are near the top of these lists over here. But there are going to be lesser known, lesser obvious ones on the list as well. That's just something maybe to worth looking into. I'm trying to, like, as I was kind of saying a little bit before I started diverging to answer your question. The idea is that I'm trying to find lots of ways to kind of like sift through companies and filter through different industries using measures that are outside of the financials. Because like that's really a lot of what I've done previously is basically gone through like various screening websites and then just screen through lists of stocks and get the current ratio I want and the operating margins I want and the return on capital that I want and all the financial measures that I like or whatever, and then try to make sure it has a good valuation as well, and then screen through stocks that way, and then be like, oh, okay, well now let's think about whether or not I like this company. Do I like this asset? After I've already decided that I like the financials and I already decided that I like the valuation, which biases you towards the thinking, oh, this must be a good asset because it is a good evaluation already. So what I've kind of come to the conclusion over the last several months is that I need to kind of reverse that process. I need to start thinking about, okay, no, what are the assets that I want to own, whether it's because it has a good company brand name, whether it's because it has a good management, whether it has a good moat or some sort of good asset that's really, really valuable to me. And think about that. Think about what do they own that is valuable to me, regardless of valuation, outside of the valuation at all, and regardless of what the financials say. Try to find the assets that you think are quality and valuable, regardless of what their operating margin is or what their gross margin is or whatever their return on capital is. Instead, thinking about KPIs, like assessing a company based off of how good its KPIs are relative to other companies in the same industry. So that's kind of the approach that I'm kind of trying to come around to now. And so these lists is just one way of kind of approaching that in terms of the management. Now, management, like as I was kind of saying before, a lot of the people that are on these lists are really, really obvious people. So it's not necessarily like the most helpful thing in the world, because a lot of those companies are going to already be very expensive, because of the fact that, like I said, everybody knows that they're a good manager. That means everybody knows it's a good company, and that means that obviously the stock's already moved upward. But either way, the point is, I'm trying to build a list of companies that are on my radar of because I would like to own them, regardless of their valuation today. Instead, so that it's more of just like paying attention and waiting for my opportunity. So that also comes back around to the themes stuff that I said at the front of that, because as I was kind of saying a moment ago, this also comes down to like the industry level. One way to approach this is to say, okay, well, I'm really interested in this industry. Let's try to determine what are certain measures that are relevant to that industry, and then assess the quality of a company based off of those industry measures rather than based off of the financial measures. One perhaps example of this would be like, I don't know, if you want to take a look at REITs, for example, rather than looking at their financials, you might take a look at like the distribution of their properties geographically by different regions that you have more of an interest in one region versus another. You could do the same thing with the vacancy rates of those regions versus their own properties and things like that. And REITs, for what it's worth, are one space that I'm hoping to maybe do a little bit of research into in the near future. Actually, REITs is one industry that I'm interested in, which has to do partially with this list of themes that are in front of us. These are um, themes and ideas that I'm kind of thinking about. I'm not necessarily doing anything with all of these or anything. These are just ideas in my head about different trends. That's kind of what I mean by a theme. A theme is something that is like a well understood trend that's kind of in place and moving forward over like a 5, 10, 15 year kind of basis. And then ideas, I would say, is something that could be a trend, but maybe it isn't already confirmed, isn't something that's already in place, is something that you think is maybe going to happen in the next few years and become a trend over the next 5 to 10, 15 years. That's what I would kind of call an idea. And then memes, I would refer to as things that people think are trends that actually are not confirmed ideas at all. And so there's at least some sort of like divergence between the idea in the kind of like the public space versus the actual reality, which could perhaps create its own type of opportunity. So that's kind of what I mean by themes, memes, and ideas. Actually mean those words to kind of be separate concepts altogether. But nonetheless, I have a different list here, kind of different stuff related to those, and I've kind of diverted it into two different lists here of higher confidence versus lower confidence, confidence slash visibility. And what I mean by that is uh, ideas that are confidence that I'm sure that's going to happen, and visibility meaning that like there is actually a lot of data backing up that that it is confirmed and it is something that is going on and moving forward. So we've got things like the boomer retirement wave, which is an idea that we've talked about a lot on this channel, and in the Discord. For that matter, since I kind of like got rolling into stuff immediately, I'll kind of stop for the moment to say, if you're watching now, either live on the replay, I'd really appreciate if you'd like the stream, to help get more people to watch the show and come join us live here. It'd be really helpful. It doesn't cost you anything to give a like, so please do if you would be willing. And also share if you know anybody that likes this type of content. Maybe share it there, or different social media networks where people are interested in this kind of content. Please share it. That's another way that you can help without it costing anything. And obviously subscribe if you haven't already. Hit the notification bell. Join the free Discord. Link is a pinned comment in the chat. It's also in the description below, but join the Discord. It is free to join, though it does have a locked up access thing, so you kind of have to wait once you join for somebody to be able to let you in. So be patient when you do join, but within a day or two, hopefully somebody will let you in and be part of our daily discussions of what's going on in the markets, in our own portfolios, different ideas of things that we're working on. So yeah, come be part of the discussion there as well. And if for some reason you are feeling generous and like the content I provide, there is also a PayPal link below. So you could also you could also donate to the channel if you're feeling so generous. So thank you for any support you're willing to give in any form whatsoever, especially those likes. Only divergence is, I didn't catch that comment before. That's tough because isn't valuation paramount as a factor of analysis? Yeah, no, valuation is paramount. I'm not saying that we don't care about valuation. In fact, valuation is key. I'm saying that I want to make it the last thing that I look at because I don't want it to bias my approach. That's what I'm saying. I'm saying that I want to try to look at everything else qualitatively to determine that I like the company, I like the management, I like the asset, I like the trend in the industry that is kind of within that trend and all the things related to that, and then look at the valuation. That's the idea. The point is, I don't want to do the valuation first because I found the company through like a screening website, so I know that it's trading under 5 times earnings or whatever, and some stuff like that. Because once you do that, it biases you to think, "Ooh, this is cheap." Now I need to justify reasons why it doesn't deserve to be cheap, right? Because most stocks that are trading at 5 times earnings, there's some reason why they're trading at 5 times earnings, right? They probably deserve it for some reason or another. Whether it's because half of those earnings are going to disappear next year, or because it's like a super cyclical company, or maybe it's because it's in a super risky region or something. There's usually some sort of reason why a stock is cheap. And so the point is that rather than finding something that's cheap and then working backwards to then try to justify why no, it doesn't actually deserve to be this cheap, which is kind of the approach I've generally had before. Instead, I want to try to find things that I think are good assets in the first place, and then determine how cheap I think they are after the fact. And if they aren't cheap, well, then we put them on the watch list and we wait for them to get cheaper. And then we move on to something else until we find something with that approach that is cheap. So it's obvious, it's not getting rid of valuation. Valuation is absolutely paramount. You're certainly right about that. But the point is, I want to make it the last step in the process so that it doesn't bias the rest of the approach. I think the doing the qualitative stuff first is more important, because then you don't bias your opinion on just how overvalued or undervalued something is, because you'll decide that, oh, this is a really great company that has a really great moat, that has a really, really great management team, because you want it to have that really, really great management team and something like that. So that's kind of my approach to it. And I'm not a trader. I'm definitely not a trader. Started with this guy, liking the stream, but I feel like if I look at the qualitative stuff, that is what biases my analysis. I can only quantify numbers. I feel qualitative stuff isn't objective enough. No, I'm not saying that you shouldn't try to make some sort of objective analysis out of it. That's why I'm trying to look at measures related to it. But you still have to make some sort of assessment of the quality of something, because otherwise, if you just went out there and bought everything that has a 20% operating margin and a 5 times earnings or something like that, you would end up with a whole lot of cyclical industries that are at the peak of their cycle. So that's my point, is that without looking at the industry closely, without looking at the management within that, you can't really have any sense of confidence in terms of where the long-term trajectory of those earnings are going to be in the future, which means you can't really have any confidence in the valuation. So that's my point, is that the qualitative stuff feeds into your ability to actually assess the value much better. And I don't know, this is something that I've just kind of learned over time, because like I said, I used to have a completely different approach where I spent a lot more time looking for companies that I was interested in through a screening process first, where I would be screening for the quantitative measures that I actually want, and then trying to decide which of the companies I liked within that pool. Instead, I'm trying to reverse the process, where instead I want to try to identify companies that I like and then wait for them to become the price that I want. Like I said, you don't take the swings anyway just because you like something. So yes, valuation is still 100% paramount. But the idea is that you want to try to like set up set up all the information that you like about a company before it gets to that valuation in the first place, so that you're kind of just waiting for those pitches to come to you, rather than looking for the companies that are already cheap and then determining which companies are the best companies out of the ones that are already cheap. I want to determine which companies are the best and then wait for them to get cheap. So like I said, just kind of a different mindset, and it's kind of just something that's I've slowly been evolving towards this approach over the course of the last year. I used to kind of have a much more quantitatively based approach, and I'm still very quantitatively based, because I mean I'm definitely a numbers person. I'm a valuation person. We're going to get to my new evaluation template here shortly, and you'll see just kind of like how quantitative I am about a lot of things when it comes to the valuation approach. Like I'm a pretty valuation purist kind of person in a large sense, but that's the thing, is like I know that that's my strength. So sorry. I spent a lot of time now trying to essentially bolster up my weaknesses, which I think is more of that qualitative assessment part of the assessment. Anyway, so let's move on to that. I'll actually kind of get into showing that off the new template. That's been the thing that's kept me from streaming for the last several weeks, and why it is I kind of waited so long, because I kind of wanted to finish the new template and get a lot of the work done with it before kind of talking about it. So first, let's kind of show what my old template looked like, which I've kind of got like right here, which was really separated into several different spreadsheets to do different pieces of the work, which kind of came all together. A lot of my evaluation videos, if anybody's watched those videos and isn't just particularly new to the channel, then you would probably recognize, especially these pages right here, because these are kind of like the main pages of the valuation template, as I've shown it a lot in the past. And right here we have Generac, which is one of the companies that's been a holding of mine for some time here. So this is one company in particular that I figured would be a good one to maybe show all of the changes between the old template and the new template. Thanks, Only Divergences. I would really appreciate that if you would. Been very light on my streaming content lately, so it does not too much of a surprise that it's going to be very slow for a little bit while kind of people get used to my regular streaming time again, and kind of get used to the idea that I'm actually going to maybe be streaming regularly, and of course I actually have to do it regularly in the first place. But any help I can get from you would be really appreciated. So anyway, here with my evaluation template, I had previously a kind of a different spreadsheet where I had all the financials analyzed together. I downloaded the raw financial spreadsheets or financial statements from Ticker. Ticker Terminal is the website that I use. They're one of their premium services, because it allows me to easily copy and paste the financial statements in up to 10 years. So that's one of the reasons I like this website. I would probably be willing to move to a different website, because it's not the greatest for some of its other there are other websites that are better at a lot of things within this website, but this website is good for how streamlined it allows its financial statements to be easily moved into a spreadsheet relative to other websites I've used. And then also I do like the screening tool they have on here. This is actually one good website where they do have a lot of good screening tools. But there, like I said, there are plenty of other websites that do stuff better. But my spreadsheet is currently designed specifically to work with that website, just because that's the one that I subscribe to. So anyway, the point is I copy paste the financial statements in here, and then that then automatically sorts a lot of the expenses and the financial measures into kind of a clean version of the financial statements, with everything kind of organized the way I like to have it organized, which I have kind of here: income statements, the cash flow, and the balance sheets, and then a variety of other things of different accounting checks and measures and things going on like that. And then it would import the information from here into into the valuation template. And the reason why I had it kind of separated into different spreadsheets previously was because of kind of how complicated certain parts of it was, especially like the tool where I put together the distribution of different valuations and the return distribution. Because basically the way this previous tool worked is that I had different inputs, one for revenue growth, with a bull case, a base case, and a bear case. So there's kind of three separate valuation kind of projections that I would make for the revenue growth path over the course of 10 years. And then I did the same thing with three different cases, a bull, base, and bear case for the operating margins. Did the same thing for capital expenses, and then same thing for both the discount rate as well as a terminal growth rate. So then that's basically 5 different inputs with which there was 3 different outcomes. And the way I had it combined together was kind of like a tree, a Bayesian probability tree, so that there ends up being 3 to the 5th power of total outcomes, which is like 283 or something like that. So it was a kind of really complicated tool to basically put together all the different outcomes, and then basically I kind of probability weighted them to kind of create this distribution right here, which was really cool. But it did require a whole lot of lines of a spreadsheet formulas down here, kind of put it all together, which made it take a while to actually put together because not all of this was easily copy pasted or dragged. There were some parts of it that kind of just had to be done manually, manually up to a certain point and then copy pasted. So it took a while actually to put this template together. And because of the way it was kind of put together like this, with like all the different lines separate like this, there was kind of a limit to how much I could do with it. For one reason, like I said, that limited how many inputs I could use because it was a power scaling. So for 3 different outcomes, every variable that I added made it to the next power. So for 3 variables, it was 3 to the 3 powers. Added to a 4th variable is 3 to the 4th power. Add a 5th variable is 3 to the 5th power. And so as it moved upward in variables, the total amount of outcomes ballooned pretty significantly. And that kind of made a limit on basically how much I could put in, because like even expanding to a 6th variable would have made this spreadsheet a lot slower in terms of its ability to calculate things. Because frankly, spreadsheets, aren't like super robust calculation engines. They're kind of limited in what they can do. I'm not a coder, and so that's one of my limitations right there, is trying to use these tools when frankly it would be better if I just learned some code. I could do things much more expansively, but whatever. I'm too busy researching industries and stuff like that. So one other limitation that created for this is that because I only had 3 separate outcomes right here, the probabilities that I assigned to each of the different outcomes for each of the different variables, I was limited in just how fine-tuned I could make those probabilities. So like here, I had 20% probability on the bull case and 20% on the bear case, and then 60 on the base case. That was kind of like the pretty generic form of what I usually did, because it kind of represented a normal distribution. But 20% was the lowest level I could go to for any of these 3 outcomes right here, before it would start to break down, just because of the way the functions worked on that final page. So there was significant limitations to it, because you might have wanted to have an outcome where maybe there was less than 20%. Maybe you wanted to represent a situation that of a revenue growth case of only 10% of an outcome, but this particular template was limited. It could literally only represent things that had outcomes of at least a 20% representation higher. So that was one major limitation of this tool. And that, along with the way the probabilities were combined together, made a limitation on the total amount of calculations you could do, which limited the amount of variables you could put together. So anyway, long-winded way of explaining the problems and the limitations of the previous template tool. It was very useful, and it was really, really cool. I don't think I've seen anybody on YouTube using anything similar to what I have here. The closest thing is Monte Carlo simulation tools, which this isn't a Monte Carlo simulation. It just gives you something that looks kind of similar because it has a probability distribution. But this is a probability distribution where you assign the probabilities yourself rather than running a simulation, which is kind of the only similar thing. Monte Carlos are honestly much cooler and much more robust if you know how to use them. But that's why the applications usually cost money to get a good one, which is why I don't have one. But anyway, so the point is, the new tool is much cooler, much better. I don't know, just had some epiphanies, some like major epiphanies that allowed me to really change up the way it does a lot of things, kind of similarly. So like I had shown you before, where we have like the financials, organized on one different spreadsheet, and then we have the template on a separate spreadsheet. I've now combined the two together because I don't really have the same calculation problems that I had previously on this one, which I'll show you in a second. So I was able to combine it together so I don't have to like transfer between different pages. So that's one improvement right there. I still have the raw financial statements downloaded from Tigger here, which then come over to the input pages where they're kind of reorganized into different categories. And then I can make, there's certain options in terms of how you want to treat certain expenses, depending on the type of company you're handling. So there's certain things you can do with that, depending on, if you understand the accounting and the different things you want to do with it. And then I also have different pages where I have kind of like a display version of the income statement, the cash flow statement, the balance sheet, because I wanted these to be like cleaner versions, not with like all these different colored bars on these ones, which are there for a reason. They're like color coded to kind of tell you what's going on, but they're not, it's not as clean to look at. So like these ones have all the numbers clean, the percentage of sales down on the sides, as well as the year-over-year growth. So I can kind of look at these a little bit more straightforward to get an idea of what's going on with the company more straight off. And then a bunch of different detailed ratio pages as well. A bunch of other things is going on as well. But then we do actually have, like I was saying, the actual DCF template inside this one spreadsheet all at once, which is a major improvement in my opinion. So rather than previously, where we had 5 variables for 3 outcomes for each variable, which gave us like 283 different outcomes. Instead of having a branching Bayesian probability tree, what I chose to do instead is basically group together different variables that are correlated, so that rather than making every variable have to be related to every other variable, which is what I did with previously, you only have one variable related to one other variable at any given point in time. And then I kind of weight them together with these sensitivity tables, 2-dimensional sensitivity tables. And then I just have many different 2-dimensional sensitivity tables, which are then probability weighted together in a standard deviation, normal distribution fashion. So rather than having 5 variables, I now have 22 different variables. And rather than 3 different outcomes, we now have 7 because I set it up to be around standard deviations. So what you do for each variable is you decide what you want the base level of the variable to be, and then you say what you want the standard deviation to be, and then you also can have a skew factor for it to tilt left or right from that average mean point in time. So you can kind of skew the distribution one way or the other if you want. But the point is because it's using a standard deviation, I just have the average mean point, and then I have 1 standard deviation out in both directions, 2 standard deviations out, 3 standard deviations out. So that gets you 1, 2, 3 times 2 is 6 plus the average, which is 7. So there ends up being 7 outcomes for each variable. And then each variable grouped into 2s with 11 different sensitivity tables. So there ends up being 22 different outcomes along with 7 different outcomes. And if you weight it together, what it ends up being, I can't remember the number, 49 for each sensitivity table, and there's 11 sensitivity tables. So that ends up being, I can't remember what the number is, but 49 times 11, that's the number. 49 times 11 is the unique outcomes that exist within this, 539. So 539 unique different outcomes, when previously it was like 283 or 287 or something like that. So we've more than doubled the unique outcomes. But then because of the way I'm probability weighting them together, on the distribution, rather than having it out of 1,000 outcomes, which is what I previously had it display out of, this is out of approximately 1,000 outcomes, it now displays the probability out of approximately 4,000 different outcomes, which I'll come over here and show you what it looks like. This is what it looks like, which in my opinion looks a lot more like what we want it to look like. See, like these are pretty good distributions, but you can kind of see like how kind of humped the probability is here, which in my opinion means that there's too much probability being weighted in like these outcomes in kind of the middle sections on either side here. They're not really kind of like curving outward. To give you a sense of it, like this is what a normal distribution looks like. This is kind of like the idea of what you want it to look like, where it's like there's a large bulk in the center here, and that kind of curves downward here in like a convex way, and then a concave way as well. So like there's a convex period briefly, and then a concave period on kind of both sides of it. Like this is kind of the shape you want. It can be more narrow than this or wider than this, but this kind of like general shape is still kind of the idea of what you want it to look like. So like this is sort of like it, but it's a little fat in these kind of like middle sections here. This is a little bit better. That's a pretty fat tail over here, but the tail is fine. It's fine that you have fat tails. It's really more about like the concavity versus the convexity at different points in the curve. So if you come over here, this is a little bit better. Now it's a very, very narrow distribution, but that's fine. It still has kind of like the kind of general shaping that I'm looking for over here. In fact, I'm fine with it being very narrow because what it means is that it's highly grouped up towards the center of the distribution. Like there's way more outcomes that are grouped up towards the center, but then it trails off towards the edges pretty widely. In fact, with I've made new templates for basically all of my holdings plus several other companies. I've already done like 22 of these at this point over the last several days. And I don't think there's a single one I've done where it didn't have at least some outcomes where the company was worth basically zero, just because of once you have a third standard deviation move on all those different variables, it just combines together to something like that. But likewise, a third standard deviation to the upside, in pretty much every single case I've looked at, has yielded an upward price that's usually several times whatever the current price is, no matter what company I've looked at. Like even some of the most overvalued companies in the market that I've looked at have had outcomes where it wasn't overvalued, but it also had outcomes where it showed that it was worth zero. So basically, it's just like the distribution is incredibly wide at the edges, at the very, very fine edges of the tail here. It goes really, really far out to the edges at a very, very minute level. But there's a much larger amount of probability stacked towards the center. And like with the previous distributions, I had often shown the third quartile and the first quartile specifically because I thought that this was kind of a good range to look at between the 25th and the 75th percentiles. Like ideally, you could say like, oh, this would be a good margin of safety and perhaps a good buy point, and this would be perhaps stretching the valuation to the point where you might want to say maybe it's worth starting to consider trimming. But using the same range, 25th to 75th percentile with the new distribution, I found yields a much narrower band in terms of the actual valuation. So like now I'm actually showing it to the 90th and 10th percentile. And even that, it still shows like a surprisingly more narrow band. So kind of show you what I mean by that. Like the distance here between the third quartile and the first quartile value here is about 60%. Okay, so it's about a 60% difference upward from the first quartile to the third quartile. If I do the same thing on the new one, I don't have the 25th and the 70th. I have the 30th and the 70th, but so I can at least give us an idea. 70th and the 30th is 12%. 12% for that one. So like instead, let's look at the 90th and the 10th. That gets us 55, 56%. So you can see like the 90th, going from the 10th percentile to the 90th percentile is similar in terms of its like distributional range to what the 25th percentile to the 75th percentile was in the old template. So that's kind of what I mean, is that there's a much larger amount of the probability weighted in towards the center, but those edges of the distribution actually go out way, way further than the previous one, which is both of those things I think are better, because that I think it means that the valuation attempts to be much more precise in its guess of where the expected value is or the median value is. It attempts to be much more precise, but it's actually much more realistic about the potential of where the value could go. It's like the truth is a stock could always be worth a lot less depending on what the market wants to assume about it than you might expect. And it could also always be worth a lot more than you might expect depending on what the market wants to assume, right? Just look at like what markets can be irrational, right? They can be irrational in both directions in pretty crazy ways. And so I think the way these distributions display everything actually depicts that a lot better. So coming back over to the DCF template, so I can kind of show you what's going on here. Anywhere there's a little purple box, that's where there are inputs. Those are where you can modify something to change the input. So that those are kind of like all the different spots right there. That's kind of what I mean by like there are 22 of them. The 22 are technically not these ones up here. Technically, it's really just these ones, because those are the ones that are on the sensitivity table. And then these ones technically are inputs, but they're not inputs that have any sort of variance to them. They're just kind of like static inputs that you put in. These inputs technically all just feed into these two, and then these ones are just static inputs they don't vary because they're just like you saying something about a static detail about the company, and the same thing about the stuff over here on the side. So similar overall, kind of like the same idea that what we had previously, where it's like you want revenue growth, operating margins, capital expenditures, things like that. It's expanded a little bit more. So like we have revenue growth, but the way we have revenue growth set up is not like one path across the entire 10 years and then just using a bull case, base case, and a bear case. Instead, like I said, we don't have bull case, bear case, and base cases. Instead, we just have an expected value, a skew to that expected value, and then a standard deviation around that skewed expected value, which gets us our bull case, bear case, and base case automatically. So we don't really need to do that. Instead, so what I chose to do is I have the revenue growth sectioned off by different parts of the cycle of the projection period. So we have the first year of revenue growth, then we have years 2 through 5 revenue growth, and then years 6 through 10 revenue growth. And we have it kind of separate sectioned off like that. So like the very near term revenue growth, kind of like the midterm revenue growth, and then kind of like the later term of revenue growth. Similar to with that, we have the gross margins, but now I have the years kind of like offlapped with a little bit. So like we did 1 year over here for the revenue growth. The gross margins we actually have for the first 2 years, because I do think that like the gross margins, or the margins in general, are kind of like a lag factor related to the revenue growth. And then there's reasons why I did that is because for the revenue growth, I only go up to year 10, whereas for a lot of the margin items, I have it go through year 10 all the way to the terminal year as well, just because of how the assumptions work. So there's kind of like a lopsidedness to how the years are shown, which I show by having like these columns offset by 1. That's because they're lined up with the years that they're for. Anyway, so the point is gross margins years 1 and 2, gross margins years 3 and 6, gross margins years 7 through the terminal year, operating expenses as a percentage of sales, years 1 and 2, 3, 6, 7 through terminal year, and then operating asset life. So this is basically our depreciation as a percentage of the assets. So that's one of the changes I made. Previously with the old template, I had my capital expenditures done as a net reinvestment measure, which kind of like encapsulates reinvestment all into one thing. And makes it so that you're just kind of thinking about what is all the capital expenditures minus all of the non-cash depreciation expenses, and what's that net amount as a reinvestment figure. But now I've chosen to break it apart because that does allow for it to be much more fine-tuned, since like the capital expenditures are often directly related to sales, whereas depreciation and amortization is usually related to the assets themselves. And then the assets themselves are usually related to sales. So there's like an indirect relationship there, but it's not, because of that not always direct relationship between it, it can create a big divergence between those things. So by separating those two out, I think it allows for me to really fine tune the way the cash flows show up for a lot of different types of situations. And I've already seen the effect of that with my reassessment. A lot of the companies have already assessed the value of, like specifically, for example, a lot of the companies that previously I thought were very overvalued, some of the larger names in the market, I still think they're overvalued, but I've found a way to see them as much less overvalued. I'm thinking of names, for example, like Microsoft or Amazon, whereas like I used to think they were very overvalued, and like with some fine tuning of some of the changes in here, I'm looking at them, I'm like, they're not as crazily overvalued, but maybe not as crazily so. Again, it depends on the assumptions you put in there. So anyway, the point is depreciation, essentially, and amortization for years 1 and 2, years 3 and 6, and year 7 through the terminal year. Then the year 1 tax rate, as well as year 10/terminal year tax rate. It's not, I just kind of have a smooth change over that time frame depending on which tax rate it ends up being. So that's why it's just kind of the 2 for those ones. Then capital expenditures as a percentage of sales. Now, when I say capital expenditures, I mean like a total CapEx figure. So this includes their actual capital spending on capital assets, but also includes intangible assets, also includes acquisitions, also includes working capital, all in as a percentage of sales for years 1, 2 through 5, and then 6 through 10. And then we have our terminal reinvestment as a percentage of the operating profits, as well as terminal excess return. So these two things together, combined with the discount rate you choose, which the beta year 1 and terminal beta, as well as risk-free rate, were some of the other inputs at the start there as well. So that determines the discount rate both in the short term and in the long term. But then your long-term discount rate, along with whatever your excess return is on top of that discount rate, along with whatever the reinvestment of your profits is, those 3 things together determine your terminal growth rate as well as determine your terminal multiple. So the terminal multiple itself kind of comes out of those things by putting those things together, which is much better than what I had done previously. Because another thing I had done previously is I had set it up so that it determined the terminal multiple and the terminal reinvestment based off of the how you had lined up the factors in those last 6 to 10 years, so that whatever happened in year 10, it kind of locked it in at that point to then be the terminal assumptions. Whereas this one doesn't really require that. You can have some different things going on for years 6 through 10, and then in the terminal year, you can have different assumptions assigned to it through these terminal assumptions, which I think is better. Again, that allows for a much more fine tuning of different kinds of situations, whether it's a company that's going to really not have a lot of business after 10 years, for example, like maybe some natural resource companies that would apply to, or some of these larger mega cap companies that are often thought of as very overvalued. And the part of the reason they're thought of as overvalued is because they have high terminal multiples assigned to them. And the reason why they have high terminal multiples assigned to them is because they have high excess returns. So the point is, in both directions, the way I've changed a lot of these inputs allows for me to really fine tune things for a lot of different types of situations and different types of companies. And like I said, I've already tested this out on 22 different companies, and I'm really happy with the results I'm coming up with. And also have these kind of cool little things over here that kind of show the assumptions, both on the next year forward basis, the forward multiples you're essentially implying with the assumptions in the valuation here, as well as the terminal assumptions, which previously I had shown terminal multiple assumptions, but I had never really disaggregated the difference of what type of multiple it is, based on the different logic of what you're looking at. So here I kind of included both of those things, both a terminal PE as well as a terminal cash flow multiple. And I think it's useful to have both of them in there, because that kind of helps you understand why one of the multiples is the way it is. Like, for example, a company might have a really high terminal PE, but that's because its terminal cash flow multiple might be lower than that. Like, so maybe a terminal PE of 20 or 25 makes sense if its terminal cash flow multiple is actually more like 15 to 17, because maybe that's because there's a large amount of reinvestment going on and a significant terminal excess return. Like, that would be one way you would end up with that result. And then likewise, you could have the other way around, where a terminal PE of 5 to 10 might actually make sense because the terminal cash flow multiple is actually like a 10 to 15. And that would be like a natural resource company that has high relative returns, but isn't expected to have business more than 15 years or something like that. So like but basically by showing two different versions of the terminal multiple here, it kind of helps explain the situation as a whole. So that's kind of like the overall inputs page for the template there. Then I have this kind of main page where it kind of shows like the main display of everything kind of as a whole. Today's date, the ticker, the company, the assumptions for next year, the sales assumption, the EBIT margin assumption, the free cash flow margin assumption, as well as the forward PE and forward cash flow multiple on a forward 1 year basis. And then I have the terminal assumptions here. So you can see like what's the sales 1 year from now, and what's the sales 11 years from now, what's the margins 1 year from now, and what's the margins 11 years from now. And then what multiple are we assuming that it theoretically trades at currently based off of the 1 year forward numbers versus the 1 year forward multiple 10 years from now in the terminal year. So, and then like I said, we have the distribution 10% to 90% valuations, as well as expected returns for them listed here. So I'm pretty happy with this. One thing about these graphs here, you may have noticed like these kind of larger bars on the side here. That's because I've chosen to have the graph bucket the outliers up to 3% and the edges there. The reason why it's 3% is because that makes 6% in total. I couldn't do 2.5, which is what I would have liked to do, is 2.5, so that it would be 5% total on either edges there. And that comes back to the standard deviation thing, where it's like up to 2 standard deviations, and then beyond that you have about 5% outside of that. So 2 standard deviations to either side of a normal distribution implies that you would have approximately 95% of the outcomes within there. So if I was able to have 2.5 on either side here, it would basically be showing you 2 standard deviations of outcomes within the inside range here. So that's approximately what we have here. That's the idea. That's why it is listed this way. Out of 4,000 outcomes as a total. So you can kind of think about that logically. 100 out of 4,000 is 2.5%. So that actually gets you that exact thing where it's like if these bars were 100 each on either side, then that would be the 2.5%, pretty much exactly. It's actually like 4,000 and change. It's like 4,010 outcomes or something like that. It's not exactly 4,000 outcomes, but it's very, very close to 4,000 outcomes. So approximately 100 on either side would be exactly those third standard deviations bucketed the other outer edges. And same thing here. So that's the new template. Like I said, I'm very happy with it. I'm very, very proud of it. And like I said before, I've also already put it to pretty solid work. I've already done like 22 different companies on it, and I'm hard at work to do many more. The many more that I plan to do is related back to a lot of that research I was talking about. I'm very, very focused on a lot of these themes, which I've kind of identified very specifically on specific themes that are specific industries that I think serve several of these themes very well. Very specifically, I'm focused on housing, electrical equipment, building in general, home building, but like building products, construction, things like that, as well as utilities, as well as home durables, and home computer durables as well, defensive stocks, business and professional services, auto and auto parts, as well as I don't have it listed here for some reason, but homes and multi home real estate, including for REITs. I'm very interested in multifamily as well as industrial. So kind of those are like different categories I'm very interested in looking at. Companies that I've valued in the past that are kind of related to that. I'm very also gold mining. I felt honestly more and more vindicated on my thesis around gold in the last year. That I've been very long on that thesis for like 4 or 5 years at this point, but I really do think that at this point the trend is just solidly confirmed. So I've been kind of diving deep into mining again, which kind of relates back to what I was saying before about trying to think about non-financial related measures to assess the quality of a company. So for mining in particular, one thing I've been doing is really thinking carefully about the geographic disbursement of their assets in like by which jurisdiction. So I've been like analyzing different mining companies based, which is what all this stuff down here is, analyzing different mining companies based off of where they hold their assets, how much of their assets they have, like how much of the resources, how many years of resources they have, as well as the average all-in sustaining costs that they have for their assets. So these are all things that are completely off the financial statements, but kind of help me assess like what are the highest quality mines to maybe pay attention to, and then like I said, wait for those valuation pitches to come my way. So doing that right now with the mining sector, and then like I said, I'm also planning to look pretty closely at REITs, and utilities, and then electrical equipment. Like those are really like the big heavy hitters, the ones that I'm most interested in the short to medium term. So doing a lot of research on the side about that, and then once I can find different companies that I like, I'll be doing some more of these little side these evaluations for them. And then one other thing, and then we'll probably be wrapping up here. I wasn't planning to do a super long show today. I just kind of wanted to give you guys an overview of everything I've been going on over here. And now I've always traditionally had my valuation dashboard over here. Obviously, this is now kind of all outdated since these are all basically the old valuations. The ones that are colored here on the side, the purple ones are ones that I currently hold, and then the orange ones are other companies I've also already updated with the new template. So you can see those are the companies that I've updated. When I said I did 22 companies, like these are the ones right here, plus like one or two that actually aren't even on this list right here. So the white ones are ones that I haven't actually made an updated valuation for, and maybe I'll grab one or two more of them, but for the most part, these are the ones that'll probably transfer over to the new dashboard, which I'm working on. A new dashboard. I'm kind of trying to start somewhat fresh. I have a different idea about how to organize that as well, so that it theoretically will also be less clunky and easier to use, which will make it so hopefully I can allow for more people to use it. Because like I currently have a few paying subscribers for the valuation dashboard, and I would kind of like to incentivize more people to pay for it. But one way I want to try to incentivize people to pay for certain paid features on it is by being able to give away other features for free, which I've come up with some ideas about how I'm going to do that. So hopefully that's gonna be something I'll be working on in the next week or two. Is the new dashboard, which will hopefully have different subsections. Hopefully I'll have like the free version, the kind of lower level premium version, and maybe a higher level premium version, and like 3 different tiers of stuff that you can see. But I have an idea of a way to reorganize it to make it so that it's much easier to pull up all my valuation stuff. And so that'll include access to these new these new template results and stuff like that. So like I said, ideas that I'm floating with and working on in the back of my mind, but I'm trying to balance, working on the new dashboard with also working on the industry research, with also doing new valuations related to that industry research. So lots of things I'm trying to work on kind of all simultaneously. You know how I always am with everything. So that's most of everything I kind of wanted to talk about today. Like I said, this is mostly just kind of like getting you all caught up on all the different things I've been doing behind the scenes. Earning season is basically upon us. So be paying attention for that. I've been paying attention to major comps for companies that I hold. We had Interactive Surgical did their earnings recently, which was a decent beat. Marsh McLennan also reported, going to be getting reportings from Texas Instrument as well as Newmont Mining. And then beyond that, my own holdings will start to report in over a week as well, starting off the bat with Heidrick and Struggles and PayPal in InMode. So very excited about that. If people didn't see any of the news about InMode did put out an early release, an early update on their earnings coming up, and they're expecting a pretty significant jump in their quarterly revenues. It actually, if they were to hit the midpoint of what they said that they're expecting, they would actually have the highest level of third quarter revenue they've ever had, and I believe it was like the third highest out of all of their quarters that they've ever had. So it looks like we're finally getting back to growth with InMode, which would be great. And then also the buyback story is really starting to take steam there. So one thing I just kind of want to call that one out in particular, since that my holding of InMode has been kind of dramatic, both in terms of a lot of people's spicy opinions on that stock, both positively and negatively. It's a very opinionated stock, and then plus its own impact on my own portfolio, being that it is by far and away the biggest loser in my portfolio currently, down 27%. So I believe I had already mentioned in the last few weeks I have picked up a few shares here and there, but I would kind of like to maybe pick up a few more shares potentially, because now I do feel like the momentum on a fundamental basis has started to move in our direction, which will hopefully lead to price momentum eventually as well. So we'll see how that one pans out, because yeah, it stands out as one of the bigger losers. We come down here to the total returns of my current holdings. It's like InMode is the one obvious big loser on there. We're also down on Mastercraft, but like half as much as we are on InMode. Both of them in double digits loser territory though, so both of them not so great. Whereas we have lots of big winners. Silvercorp has been on an absolute tear lately, and we might be thinking about trading out of that one at some point. That's one of the reasons I've been looking at the mining companies as close as I had to try to determine which are like the best assets to hold for the long run in the mining sector. And one of the reasons why I'm doing that in mining in particular is because my current mining holdings have definitely, I think, starting to reach pretty mature levels in terms of their valuation. So I might want to be trading out of them potentially in the future. And both Silvercorp, which is largely Chinese holdings that is segmenting into Central and South American holdings, both of which are pretty risky in their own regards. So that's not exactly a super great long-term asset in terms of geographic disbursement of where its ownership is. And then Barrick is pretty widely geographically dispersed both across North America, South America, and Africa. The North American part's great, and some of the South American parts are okay, but then the African parts are pretty risky as well. So that's a pretty risky asset. One thing I haven't even commented on before, the other gold miner I had previously, New Gold, I had sold out of that one because I thought that valuation had reached a pretty rich level. And I will say, I actually sort of regret that at this point. One, because that was a gold company that had all of its assets actually in North America, which made them significantly safer. And then two, having rethought that valuation a little bit with the new model, I actually think that they weren't as bad of a valuation as I had previously thought. So I kind of regret that. It's possible that on pullbacks, I could enter back into the stock, even though it's currently above where I sold out of previously. But we made significant captured gains on that previously. So, in some ways that would buffer it us. But the point is like, I do feel like selling out of this one was potentially a mistake. I feel like maybe I should have just held it for the long run. So on pullbacks, I could potentially try to re-enter this one in like I said, my attempt to essentially build into some more longer term safe mining holdings based around North America, especially in particular because of just kind of the geographic jurisdictional friendliness of that region. But nonetheless, whatever the point is you make mistakes, you recognize the mistakes you made. So that's where we are with our portfolio, and that's where we are with our research and everything we're doing.
I would call on it again. If you're watching live on the replay, please like the stream. It'd be really, really appreciated. It's like one of the easiest, low cost ways that you can help me. Subscribe to the channel if you haven't already. Share the content if you could or would. Join the Discord, like I said below. Be patient with how quickly we get you in, but because it does take manual acceptance, but given some time, we will get you in. And if for some reason you're feeling extra generous, the PayPal link is also listed below. So, all right, I'll catch you all in the next stream or the next valuation video, whichever one comes first. I appreciate everyone who showed up here today. Thanks.